We're starting with chapter 8. Next week's chapter 9. I'm getting ahead of myself. We're starting with chapter 8 today with liabilities. Once again, if I'm going too fast, tell me to slow down. It's totally what I want to hear from you guys, how I can help you process this material better. Current liabilities. So we're going to talk about the difference between what a current liability is versus a long-term liability. A liability is an obligation of a company to transfer some economic benefit in the future. Most liabilities require the payment of cash in the future. Those would be accounts payable, notes payable, salaries payable. There are some other liabilities, such as deferred revenue, that happen because we get cash in advance but haven't performed the service yet. Those liabilities represent an obligation of the company to transfer inventory or services to those customers in the future. So I always say it's a current benefit for a future sacrifice. In other words, there's something we need to do in the future. Okay? So with the payable, we receive something. We might have received supplies or we might have received cash for something we need to do in the future and give back. Does that make sense? Current liabilities are usually payable within 1 year. Okay? Long-term liabilities are due in more than 1 year. So a current liability is going to be one such as salaries payable. No employee is going to want to wait a year to get their salaries paid to them, right? 2 weeks at the most is all they're going to wait. That is a current liability. Whereas a long-term liability would be a car note. You don't pay that car note usually up in a year. Usually it's 4 or 5 years. Okay? I'm not going to get caught up in operating cycles because 99% of businesses operate over a 12-month period. When they talk about an operating cycle, usually we say a current liability is within 1 year or within one operating cycle. Basically, most companies run on an annual or yearly basis. There may be some companies whose operating cycle is longer than a year. Like the example here is a winery. For them to make the product and finally get the product out, it may take longer than a year in order for them to complete that process. Okay? I've seen some construction companies as it results to like constructing freeways. Do you guys remember 35W? How many years that sucker took? You know, some companies usually have a longer period for their process to occur. So here you see the section on the balance sheet for Southwest Airlines that just shows the current liabilities. You've got the accounts payable, some accrued liabilities, current operating lease liabilities, air traffic liabilities, and one piece we do show as current liabilities are the current debt paid on long-term liabilities. So let's just say you have a 30-year mortgage. That portion that's due this year on that 30-year mortgage is reclassified as that current liability because that's the amount that you have to pay this year. Okay? Guys, which of the following is typically considered a current liability? Would it be salaries payable? What is prepaid insurance? Asset. Yes. What is mortgage payable due in 30 years? Long-term liability. And what is accounts receivable? Asset. Good, guys. In most cases, current liabilities are payable within 1 year from the balance sheet date, and long-term liabilities are payable in more than 1 year. So, how do we go about accounting for notes payable and interest expense? So, a note payable usually is a written document. It's a signed, written note. It's signed by the firm that promises to repay the amount borrowed in addition to the interest. The way we calculate interest is we take the amount of the note and we come up with the annual percentage rate. Whenever you see an annual percentage rate like 7%, know that is over 12 months. It's not over 1 month or 2 months. It's over 12 months. And then we take that portion of a year that we're accounting for. Okay? So if Southwest borrows $100,000 from the bank on September 1st of 2024, signing a 6% 6-month note for the amount borrowed plus accrued interest due in 6 months. It's due March 1st of 2025. But how will we account for receiving the money on September 1st? Guys, no interest has accrued yet. We just got the money. Okay? So we will debit our cash and we will credit notes payable. Okay? Now, at the end of the year, we need to adjust our books. Okay? So everything's current and it's reflecting the interest we owe the bank. Okay? So on December 31st, we've had the note for how many months? Only 4. All of September, all of October, all of November, and all of December. Does that make sense? 4 months. So the way we're going to calculate the interest is the 100,000 times 6% times 4/12 or 1/3. Does that make sense? A lot of times what I do, just in my crazy mind, is I do 100,000 times 6%, 6,000. Divide that by 12. See what I'm saying? 500 times 4 months, 2,000. Do you guys get what it's the same thing, but I'm just kind of letting you know in my head how I process it. Okay? So as of December 31st, we're going to show interest expense of $2,000 and interest payable of $2,000. This is to record the interest that's been incurred on the note but not yet paid. No, we keep it separate from the note payable. Okay, we keep what we owe on the note separate from the actual note payable. Okay? Any questions on that? When calculating the number of months of interest, students sometimes subtract December from September and getting 3 months. You see, they go, oh, December's month 12, September's month 9. Oh, it's only 3 months. Again, call me goofy, but I like count on my fingers. September 1st, like all of September, all of October, all of November, all of December. So don't just kind of like add and subtract. Really methodically think through how many months. We're dealing with all of September, September 1st. If it would have been September 30th, then it would have been 3 months. Okay? So when the note comes due on March 1st, 2025, Southwest Airlines will not only just pay the face amount, the $100,000, plus the entire $3,000 of interest. So we have to record the interest that's incurred in January and February on this note. So again, how would we record it? We would show $100,000 times an annual interest rate of 6% times 2 months out of 12 months. Okay, 1/6. So here you see we don't show this now as an interest payable. We show this as an interest expense because we're paying it right now, right? The one in December, the interest expense, the entry was interest expense, credit interest payable. That expense needed to happen in the year in which that interest was accrued. So for this journal entry, we need to show the interest expense for those first 2 months of January and February. We need to zero out the note payable because we're paying them back. We need to zero out the interest payable because we're paying what we owed from December 31st off. We're recording the interest expense for the first 2 months, and we're paying the full amount of $103,000. Make sense, guys? Got it? We record interest expense in the period in which we incur it rather than in the period in which we pay it. Really important. Okay, guys? How about this question for you? On October 1st, a company signs a $10,000, 5%, 6-month note payable. How much interest would be recorded by December 31st of the same year? Any ideas? 10,000 times 5% is $500, right? How many months are we showing for this year? 3 months. So wouldn't it be half of it? 250? Does that make sense? Oh, B, what am I doing wrong? 3 months. Oh my God. 250 is the amount for the entire. Yeah, I'm the teacher, huh? Sorry, guys. So 250 would be the amount for the loan for the 6 months. Half of that is 125. How about, would you believe I did that on purpose? Okay, let's look at this one, guys. Eskimo Joe's designer of the world's second best-selling t-shirt borrows $21 million cash on November 1st 2023. Eskimo Joe's signs a 6-month note, 7% promissory, to Stillwater National Bank under a prearranged short-term line of credit. Interest on the note is payable at maturity. Each firm has December 31st as a year end. We're going to prepare the journal entries on November 1st, 2023 to record the note payable for Eskimo Joe's and the note receivable for Stillwater Bank. And then we're going to record the adjustments on December 31st for each. And then we'll record the payments for April 30th. Okay, so we're going to do it on both sides. On the one who borrowed the money and on the one who's the bank. So, $21 million, what we would do for Eskimo Joe's, they are receiving the cash, $21 million, and we credit notes payable. For the bank, we're going to show it as a notes receivable. Isn't it a notes receivable? And we credit cash. Now, on December 31st, 2 months, right? 2 months of interest. 21 million times 7% times 2/12 is 245,000. That is interest expense, 245,000, and we would credit also interest payable of 245,000. This is to record the interest expense incurred but not paid. Then, for the bank, they are going to show interest receivable. They haven't received the cash yet, so it's an asset, interest receivable of 245,000, but they will show the revenue because they did earn it. They just haven't received it yet. Okay? Then, on April 30th, when the note is due, that's 4 months, isn't it? That's 4 months of interest. So we need to calculate for Eskimo Joe's 21 million times 7% times 4 months out of 12 months to show interest of 490,000. We are going to debit our interest payable because we're paying off that interest now. Liabilities normally have a credit balance, but since we're paying it off, we're going to debit it, so we zero it out, correct? We're going to debit the note payable because we're paying that off, and the full amount is going to be cash. Okay? Do you see with the bank is receiving all this cash, and instead of showing interest receivable, since we're receiving it right now, we're going to show those 4 months as interest revenue. We do credit the interest receivable that we are now getting. And then we credit our notes receivable. Any questions on this at all, guys? Is it kind of making sense? Now, a line of credit is basically an informal arrangement that allows a company, when they need it, to borrow up to an amount that's prearranged. It's similar to a notes payable, but it's always open and available. So they will, at the start of, with the bank, sign an agreement that says when we need up to X amount of dollars, we can borrow it and then pay it back as we need to. It's just an open-ended ability to borrow money. We're going to record that just like we did here. Commercial paper is where one company lends money to another company instead of borrowing from a bank. Usually the interest rates are lower. Usually there's an incentive for one company to lend money to another company. Think about this. They work side by side in developing products or production, and if one company needs the money, it's to the incentive of that other company to help them so production doesn't slow down. Okay? Commercial paper is between two companies, and usually the interest rate is less. Okay? Okay. No, guys, many short-term loans are arranged under an existing line of credit with a bank, or for larger corporations in the form of commercial paper, which is one company borrowing money from another company. Now, another type of current liability are accounts payable. It's just amounts that are owed to suppliers of merchandise or services. Utilities, utility companies, electric companies, companies who maybe we purchase supplies from them and they have a standing arrangement where we have to pay it within a certain period of time. Sometimes these accounts payable are also called trade accounts payable. Usually they're short-term liabilities. Depending on the due date, they could be long-term liabilities, but generally speaking, they're going to be short-term liabilities due within the year or much sooner. Now, one big piece in this chapter is learning about payroll. With payroll, that is a liability companies have. And so we need to learn and understand all the various types of costs that are associated with payroll. Know that an employee, how many of you guys have had a job and had a W-2 employee? Good. So you understand that if you're making 20 bucks an hour, you don't see 20 bucks an hour, do you? They take out federal and state taxes. They take out your portion of Social Security and Medicare, which we also call FICA. If you have health insurance or life insurance or any of those insurances, they take that out. And if you're investing into a retirement plan, they'll take that out. So you end up with the gross minus all of those items they take out. The employer also pays certain things. They have to pay federal and state unemployment. They have to match what you pay in Social Security. Your employer has to match it the same amount. So when they take out 7.65% of Social Security taxes on your salary, they also are required to match, pay exactly 7.65% on your salary up to a certain amount. I think it's right now $147,000. They, oftentimes with employers, they pay a portion of your insurance. They might make you pay a portion of it, but then they pay a greater portion. So the employer contributions for health, disability, life insurance. And then the employer's portion or contribution to any retirement or savings plans that they're responsible for. So we're going to talk about all these various costs that are incurred with paying payroll. Federal and state income taxes. Federal taxes vary based on your tax rate. So depending on if you're married or single and what your income is, is based on what will need to be withheld from your check for federal taxes. There are, I believe, about 11 states in the country that don't have state income tax. But Minnesota has a hefty state income tax, as you guys are probably aware. So state income tax is taken out of your check. And the FICA tax, or Social Security and Medicare, 6.2% is for Social Security, and 1.45% is for Medicare tax. Okay? Now, Medicare does not have a maximum. Social Security caps out at, I think this year is 147. Or maybe that was last year. Medicare goes on and on forever. This helps fund the Medicare program for seniors. Employees may have additional amounts withheld from their paychecks for health, dental, disability, or other amounts for retirement. And then again, with the employer, they've got to pay the exact same amount as the employee's Social Security and Medicare, and then other expenses. The one thing that employers pay that employees do not pay are the federal and state unemployment taxes. Okay? Many people think FICA taxes are paid only by the employee, but that's not true. They have to match. Okay? So here we've got an example of the Hawaiian Travel Agency has a total payroll for the month of January of $100,000 for 20 employees. And then they show how much was withheld for federal and state taxes, the FICA rate, the health insurance that was paid by the employer, the contribution to retirement plans paid by the employer, and the federal and state unemployment tax. So Hawaiian Travel records employee salaries expense withholding and salaries payable on January 31st. So this is the employee side of the piece. They're going to show salaries expenses $100,000. They're going to also credit some liabilities. Employee income tax payable $24,000. That's what they took out of their payroll. They have to transfer over to the various agencies. They credit FICA tax payable for the 7.65%, and then the rest goes to the salaries. So they credit then salaries payable of $68,350. Okay? Bless you. Then on the employer side, we have to record the employer provided fringe benefits as a salaries expense. So those items related to health insurance and 401ks all get added as a salaries expense too. It's compensation, just not in the form of cash. And we show those fringe benefits as payables. Note that the Social Security that the employer has to pay and the unemployment is treated as a payroll tax expense. And we credit the FICA tax payable for the 7.65, and the unemployment tax, they're telling us, is 6.2%. So there's a lot more than just when you see your pay, that's it. Depending on what company you work for, sometimes the fringe benefits can be another 40% of your pay, up to 40%. Make sense? Remember, employee salaries are reduced by withholdings for federal and state income taxes, for FICA taxes, and the employee portion of insurance and retirement contributions. The employer also incurs additional payroll expenses for unemployment taxes, the employer portion of FICA taxes, and any additional employer-reported benefits, insurance, and retirement contributions. Okay. How's everyone doing so far? Good. Which of the following items is typically paid by the employee, the employer only? Excellent. So here we're going to look at Downtown Diners. Pays employees monthly. Payroll information is listed below for January, the first month of DD's fiscal year. Assume that none of the employees exceeds the federal unemployment tax maximum salary of $7,000 in January. So basically, federal unemployment caps at $7,000, and it's capped at $7,000 for a lot of years. So once an employee reaches $7,000, the company doesn't have to pay any more federal unemployment on them. So we'll record salaries expense and payroll tax expense for the January pay period. So we see our salaries expense of $600,000, federal and state income taxes of $120,000. The federal unemployment rate is 8.8%, and the state unemployment rate is 5.4%. The Social Security is 7.65%. So we're going to show we debit our salaries expense, $600,000. We credit employee income tax payable, $120,000. We credit our FICA tax payable, $45,900. We credit salaries payable. That's what's going to go into the checking account. We will show for the employer payroll tax expense of $83,100, which includes the FICA tax payable, their portion, and the unemployment tax payable. Okay? That's the state and the federal. Let's look at some homework. You want to do that? Precision Castparts, a manufacturer of processed engine parts in the automotive and airline industries, borrows $41 million cash on October 1st, 2024 to provide working capital for anticipated expansion. Precision signs a 1-year, 9% promissory note to Midwest Bank under a prearranged short-term line of credit. Interest on the note is payable at maturity. Each company has a December 31st year end. So prepare the journal entries on October 1st, 2024 to record the note payable for Precision Castparts and the notes receivable for Midwest Bank. So, and this amount was $41 million. So for Precision, what are we going to do here, guys? Debit, cash for 41 million. Credit, notes payable, right? Okay. Then for the bank, we're going to debit notes receivable, and credit what? This is recording the, excuse me, am I doing something wrong? Prepare the journal entries October 1st to record the note payable. Okay, maybe I could bring it down here. Prepare the journal. Yeah, requirement 2 is the December 31st, so you're exactly right. So maybe I need note payable for precision. And B, where do I find B? Okay, guys, I'm so sorry.
And then press record entry, right?
Yeah.
At the bottom, record entry. And then it takes you.
Thank you. So, notes receivable, 41, and cash, 41. Got it? Now, the next one is to record the adjusting entry on December 31st, 2024. It's a 9% note. 41 million, 9%. We took it out in October. How many months is that? 3 months. There. So let's view this. Get rid of that. So for precision, 41 million times 9% is what, guys? Times 3 months. I'm sorry, 2,000. $41 million. Thank you. 922,000. 922,500. And we got that by saying 41 million times 9% divided by 12 times 3. Got it, guys? Then for Midwest, it's going to be interest receivable, right? 922.5, and interest revenue, right? Not accounts receivable, interest revenue. Okay? Are we good? Do you agree? Oh, gosh. No, I wanted to view journal entry. Interest expense, and this is interest payable. Okay? Are we good? Then we need to record the repayment of the note and payment of interest at maturity for Precision Castparts. So how many months are here now? 9 months. So what are we going to show? Well, the first thing we'll do is notes payable. We debit of 41 million, right? We're also going to show our interest payable that we recorded in December of 922.5, right? We need to show an interest expense of the 41 million times 9%, 2,767,500. So that's 41 million times 9% times 9 months out of 12 months. And the cash is anyone want to add those? 44,600,000. Right? Then record that entry. Then for the Midwest Bank, we're going to be debiting our cash for 44,690,000. We're going to show interest revenue of 2 million, whatever that number was. Then we're going to show interest receivable of, what was that? 922.5. Then we're going to show notes receivable, 41. Does that make sense, guys? Any questions on that? Gosh. Darn it. Notes payable. Sorry, guys. Okay? Next. Caribbean Tours total payroll for the month of January was $600,000. The following withholdings, fringe benefits, and payroll taxes apply. Assume that none of the withholdings or payroll taxes have been paid by the end of January, record them as payables, and no employees' cumulative wages exceed the relevant wage bases, which means they haven't gone over the amounts. Record the employee salaries expense, withholding, and salaries payable, and then we'll record the employer, fringe benefits, and then the employer taxes. So I want you guys to attempt to do this. Let's take a minute and try this, okay? Anyone want to start with the employee salary expense? Debit 600,000 to salaries expense, right? Okay. Next. Federal and state income taxes withheld, 60. So what will we say here? Payroll taxes payable. What's the word? No, this would be tax, income taxes payable.
Employee income tax payable.
That's it. Employee income tax payable, 60,000. Employee FICA tax payable. Okay, thank you. FICA tax payable is 7.65% of the 600,000. I'm sorry. 45,900. Anything else? Salaries payable will be the difference, or how many agree? Perfect. Now, we need to record the employer Do I just keep going on, or?
Yeah, the journal entry worksheet or transactions.
Thank you. There it goes. Okay, so I'm going to record that entry. Then record the employer provided fringe benefits. So we have health insurance premiums paid by the employer, 10,000. Contributions to retirement plan paid by the employer to Fidelity, 24,000. So what are we going to debit? Salaries expense, right? And it's going to be the 10 and the 24, so 34,000. And then what will we have? Fringe Benefits payable to Blue Cross is 10. Fringe benefits for Fidelity is 24. What did I do wrong? Health insurance, 10. I'm sorry, what? Salaries, 10. Okay, that was number, there, okay. 10. I'm so sorry. That is tricky, guys. Sometimes you can't see that. 34.8. Got it? Are we good? Then the next is record the employer payroll taxes. And what does the employer have to pay? The FICA and 6.2 federal and state unemployment rate. So what are we going to say? Payroll tax expense. And we're going to credit FICA taxes payable. And we're going to credit unemployment taxes payable. So on 600,000 times 7.65%, what was that? FICA tax? 45.9. And then for unemployment on 6.2%, 37,200. And what's the total there? 80. Got it right for once. Does that make sense? So you've got another one, this vacation's destination. It's the exact same scenario that we just did. Okay, now let's go back to the PowerPoint. Going back here, we now are going to talk about deferred revenues. Deferred revenues, cash received in advance from a customer for products or services to be provided in the future. So, salaries tax payable is another what we call current liability. Sales tax collected from customers by the seller, representing the current liabilities payable to the government. So know when salaries tax is payable, you are a restaurant and the meal is $20. That is your revenue minus whatever costs you have. But the sales tax, it just went up recently. Say the sales tax of 8% isn't for you to keep. It's to go to the state of Minnesota, isn't it? So we're going to learn how that gets reported. Another current liability is called the current portion of long-term debt. That debt on long-term debt, that's going to be payable in the current period. So assume Apple sells iTunes gift cards to customers for $100. Apple records the sale of the gift card by debiting cash and crediting deferred revenue. Okay? Because all we've done is sell the gift card. When the customer purchases and downloads $15 worth of music, then Apple will debit the deferred revenue and credit the sales revenue. Okay? Some students think deferred revenue account is a revenue account, but you guys know better. Since the account has the word revenue, but don't let it fool you. that is probably the only liability that doesn't have the word payable after it, right? Okay. Apple is the #1 online music retailer through its iTunes Music Store. Apple sells iTunes gift cards in $15, $25, and $50 increments. Assume Apple sells 21 million of iTunes gift cards in November, and customers redeem 14 million of the gift cards in December. Okay, so what we'll do when they sell them, we debit our cash and we credit our deferred revenue. When customers redeem $14 million worth of gift of music, it's at that time we'll debit our deferred revenue and then credit our sales revenue. So do you see at the end of December, we have $7 million sitting in our deferred revenue account? Does that make sense, guys? So 21 million is what we began the deferred revenue with. 14 million was redeemed. Therefore, we have 7 million left. Okay? For sales tax, you buy a lunch at the airport for $15 plus a 10% sales tax. The airport restaurant shows the cash as $16.50. But it shows the sales revenue to be 15 and the sales tax payable, the amount that needs to go to the state, of $1.50. Okay? This is really helpful. The amount of sales tax is the total cash paid minus the total cash paid divided by 1.10% in this case. Okay? To figure out how much you need to pay in sales tax. Sales taxes collected from customers by the seller are not an expense. They go right into a liability because they go to the government. Now, the current portion of long-term debt is the amount that the company is going to be paying in debt for this year on that long-term debt. Why do you need this? Because you need the money to pay the debt. So suppose a company has a long-term note payable of $1 million. At the balance sheet date, the company determines that $200,000 of the note is due within the next 12 months, and while the remaining $800,000 is due in later periods. The company needs to reclassify $200,000 of the long-term note to current notes payable. So it currently shows $1 million. Now what we're going to do is we're going to debit that notes payable, because remember, payables have a normal credit balance. By us debiting this, it reduces $200,000 from long-term notes payable, and we credit it to short-term notes payable. Okay? First step we do. So you see here on the balance sheet with Southwest, the current maturities of long-term debt, that $566,000 constitutes that money Southwest has to pay this year in debt on their long-term debt. Okay? We report the currently maturing portion of a long-term debt as a current liability in the balance sheet. Let's take this one, guys. Why don't you guys try to work on this one? Tell me what you think. Sure. How much is recorded in the sales tax payable account? 200 times 6.5%, right? Now, we're going to talk about contingencies. What is a contingency? The best example I can provide for you is, how many of you guys have ever purchased a warranty? Okay? Oftentimes it's not a bad idea to purchase a warranty on computers, is it? Because the likelihood for me to drop it, something to go wrong, happens. There are warranties on a lot of things. The best one I can tell you that my husband and I have had is, we purchased an RV in 2014. And we have probably taken it to the dealer in the first 2 years. The warranty was good for 2 or 5 years, I can't remember. But my husband would drive it up to Canada and they'd have to replace a door or replace the shower. That costs money, doesn't it? And companies, when they have products, they know stuff is going to happen. Okay? It's just part of making products. And so they need to take into account, companies need to take into account that contingency when they sell goods. So, a contingency is an uncertain situation that can result in a gain or a loss for a company. A contingent liability is an existing uncertain situation that might result in a loss. Examples: lawsuits, product warranties, like what we're talking about, pending investigation or pending cases, a bank guarantee, lawsuit for the theft of a patent or for whatever, a copyright, change of government policies, change in foreign currency exchange, liquidating damages. So there's all kinds of potential issues that could create contingencies. But here's the deal with a contingency. Depending on the likelihood determines how we report it. If the likelihood of payment that we're going to pay out is probable, it is likely to occur, then we're going to do something different than if it's reasonably possible. Reasonably possible is more than remote, but less than probable. Or remote is the chance is slight. Okay? So you could pick anything to be remote. That a hurricane's going to hit Minnesota. Pretty remote, won't it be? Okay? So you're not going to report a contingency like that. The amount of payment, if the amount of payment is reasonably possible, estimated, or not reasonably estimated. So these are the factors in how we're going to report it. A contingent liability is recorded only if a loss is probable and the amount we can reasonably estimate. That's it. If it's reasonably possible, you're not going to report it. Okay? And if you can't reasonably estimate the amount, we're not going to report it. So we're going to report a contingent liability only if it's probable and the amount we can reasonably estimate. So if it's probable that Jeeps Inc. will lose $100 million lawsuit at some point in the future, Jeep records the entry as a loss of $100,000, and we credit this liability, current liability, called contingent liability for $100,000. So it's a loss. We record the loss in the current year because remember how we always want to match our revenues with our expenses. Okay? So even though the work or the lawsuit might happen in the future, we need to show it in this current period. The most common example of contingent warranties, liabilities, is a warranty. A warranty for a product represents a liability for a company at the time of the sale if it meets the criteria for recording a contingent liability, that it's probable and we can reasonably estimate the contingency. Even if the company doesn't know precisely what the warranty costs will be, it can formulate a reasonable prediction based on past experiences, industry standards. So assume warranty costs on a specific product are estimated to be 3% of sales. December 2024 sales are $1.5 million. The following adjusting entry is recorded. We debit our warranty expense and we credit our warranty liability. But if in January of 25, after the year's over, we have 12,000 of claims that we took care of, it's then we will credit our warranty liability and debit our warranty liability and credit our cash. Why do we do that? Because we want to record the expense in the year the sales were made. So we did record the expense in the year the sales were made up here in 2024. So now when we get warranty work, we're just going to offset that liability account. Do you see? We initially estimated $45,000 of liability, contingent warranty work. And when we actually paid out the $12,000, our new balance now is $33,000. Okay? Computer Wholesalers restores and resells notebook computers. It originally acquires the notebook computers from corporations upgrading their computer systems, and it backs each notebook it sells with a 90-day warranty against defects. Based on previous experience, Computer Wholesalers expects warranty costs to be approximately 6% of sales. Sales for the month of December are $600,000. Actual warranty expenditures in January of the following year were $13,000. Does this situation represent a contingency liability? Yes. They're probable. It's probable, and we can reasonably estimate it. Record the warranty expense and warranty liability for the month of December based on 6% of sales. Well, if the sales are $600,000, we're going to debit our warranty expense here for $36,000. Sorry, guys, let me fix this. We'll debit our warranty expense for $36,000 and we'll credit our warranty liability for $36,000. When in January actual warranty work happens, it's then we'll debit our liability for $13,000, and we credit our cash for the work that was done. Okay? At the end of the month, we showed in the liability account the initial $36,000. Then we did the payment of $13,000, so we're sitting with $23,000 left. Okay? Which of the following statements is true with respect to warranty liabilities? See? Excellent. How about this one? During the first year of business, Oceanic Inc. has sales of $300,000 and pays warranty claims of $10,400. Oceanic offers a 1-year warranty and anticipates that warranty costs will be 5% of sales. What is the balance of Oceanic's warranty liability account at the end of the first year? I'm sorry, what? $4,600, the warranty liability account. So we've got, if the warranty expense was $15,000 and the liability was $15,000, and we made payments to that of $10,400, the 15 minus the $10,400 gives us our $4,600. Okay? Some students think the balance in the warranty liability account is always equal to warranty expense. Remember, the warranty liability account gets increased when we estimate the warranty liability. But then as the claims come in, it's being reduced each time. Okay? Right? An existing uncertain situation might result in a gain. We never, ever, ever report contingent gains. Okay? We don't record the gain until it's known with certainty. I could win the lottery. So what? When I win it, I can show it the income. Right? Unlike contingent liabilities, contingent gains are not recorded until the gain is certain. Okay. Pacific Cruise Line. Pacific Cruise Line, excuse me, is a defendant in litigation involving a swimming incident on one of its 3 cruise ships. For each of the following scenarios, determine the appropriate way to report the situation. The likelihood of a payment occurring is probable, not probably, probable, and the estimated amount is $1.3 million. Are we going to report it? We're going to report it. We're going to show the loss and the contingent liability. Pacific Cruise Line should record a loss and a liability. Okay, and this is number 2, sorry. Number 2, the likelihood of a payment occurring is probable, and the amount is estimated to be in the range of 1.1 to 1.6. Are we going to record it? Yes. Here's the weird part. Normally, everything we do in accounting is a conservative approach, right? But for some reason, with warranties, we're going to use the lower number. So in this case, we're going to use the minimum amount, $1.1 million, as what we estimate the loss to be. Not the high end, the low end. Then, number 3, the likelihood of a payment occurring is reasonably probable, and the estimated amount is $1.3 million. Are we going to do anything? No. And the likelihood of payment is remote? We're not doing anything there either. Okay? Now you guys can review your liquidity analysis as it relates to debt. Again, Chapter 12 will be covering all of these ratios. That's it. Would you guys like to do some homework? Texas Roadhouse opened a new restaurant in October. During the first 3 months of operation, the restaurant sold gift cards in various amounts totaling $3,500. The cards are redeemable for meals within 1 year of the purchase date. Gift cards totaling $728 were presented for redemption during the first 3 months of operation prior to the year end on December 31st. The sales tax rate on the restaurant sales is 4%, assessed at the time meals are purchased, not gift cards are purchased. Texas Roadhouse will remit sales taxes in January. Record in summary form the $3,500 in gift cards sold, keeping in mind that in actuality the company would record each sale as a gift card individually, and the $728 in gift cards redeemed. Hint, the $728 does include a 4% sales tax of $28. So let's look at here, record in summary form the $3,500 in gift cards sold, keeping in mind that in actuality the company would record each sale as an individual gift and the $728 in cards redeemed. So what are we going to debit? We're going to debit cash. Cash is how much? $3,500? $3,500. We're going to have deferred revenue of the amount that has not been redeemed. How much has not been redeemed? $3,500 minus the $728? Okay, so, but would you agree the cash should be $3,500 right here? Okay, so what would our sales, the deferred revenue initially, I guess, would be $3,500, but we're trying to do a summary of it all. So the $3,500 minus the $728, which were redeemed, would give us what? Am I making sense? Make sure I'm doing it right. They want us to do it in summary, so I'm assuming that means they want us to show I just want to make sure I'm not leading you astray on this one. You know, initially it was all a warranty, but then it changed. So let's see here. So the way okay, I guess we'll start with $3,500 like this, and then the next entry is where we'll then say the 728, we deferred revenue, we'll debit our deferred revenue of the 728, okay? And then what are we going to show here? Sales revenue is how much? $700, because didn't they tell us $28 is the sales tax? Sales tax payable. Does that make sense? Gosh, I swear I did that, but right? Okay. Record the 728 and gift cards redeemed. Then, the next thing, determine the balance in the deferred revenue account. Remaining liability for gift cards. $3,500 minus the 728 is what? $2,772. Got it, guys? Make sense? Yes.
Is that taking you? So it said earlier that there was 20 for sales tax.
Correct. But remember, they told us 728 was redeemed. So that 728 included some sales tax, but that was redeemed. So if we initially sold 3,500 of gift cards and 728 of it was redeemed, it doesn't matter what went to sales tax in that respect because that all got used up. So we do show the deferred revenue here being the 728. That's been used. And then here's where we show sales revenue of that's how much the meal cost. And $28 is what we owe to. Okay? Okay, guys, let's see what's next. Okay?
That was happening to me too, but if you click the 6 or the 9 squares, right, yep, and then the
Thank you. Isn't that weird? You know, I've never complained to McGraw-Hill as much as I've done this year because you're paying for this. Okay, so number 6, the inkjet printing division of Environmental Printing has grown tremendously in recent years. Assume the following transactions related to the inkjet division occur during the year ended December 31st, 2024. So you've got 3 scenarios. And determine the appropriate way to handle it. So, and one thing I didn't tell is, if it's reasonably probable, you should record it disclose it in your notes to the financial statements. But that's all you do. You don't record an entry. But here it's telling you, Environmental Printing is being sued for $11 million by Adamax. Plaintiff alleges that the defendants formed an unlawful joint venture and drove it out of business. The case is expected to go to trial later this year. The likelihood of payment is reasonably possible. What are we going to do? Disclose it, but there's no journal entry, right? So in this one, no journal entry. Okay? Next one. Environmental Printing is the plaintiff of a $9 million lawsuit filed against a competitor in the high-end color printer market. Environmental Printing expects to win the case and be awarded between $6.5 and $9 million. What do we do with gains? Nothing. Okay? Environmental Printing recently became aware of a design flaw in one of its inkjet printers. A product recall appears probable. Such an action would likely cost the company between $500,000 and $900,000. What did we decide? We always use the lower figure. Goes against accounting conservatism, but that's what we do. So what are we going to do here? We're going to record it because it's probable. We're going to show a loss of $500, and we're going to show a contingent liability of, great guys. Okay? Does that make sense?